There was once a doctor in a remote village who used one of the oldest methods of making medicines through natural remedies. His methods later laid the foundation for much of modern medical research, yet people continued to rely on his original, albeit somewhat rudimentary, medicine techniques. Welcome to a new video of the Polynomial Academy, a series where we will discuss the most important crypto trading and DeFi concepts. Today, we are going to talk about the financial twin of the doctor that I just mentioned, whose work formed the bedrock of the technical analysis. We'll also talk about how his Dow theory can help you identify the market trends. But here's a trend that needs to be changed: watching these videos without subscribing to our channel. So make sure you subscribe, and now we'll get started. Dow theory is based on a collection of letters written by Charles Dow, which were first published in the Wall Street Journal over a century ago. Charles Dow was a pioneer of the technical analysis and the creator of the first ever stock market indices. Remember, Charles Dow developed his Dow theory in a time without indicators or other research tools. That's why he based it on first principles like price trends and volumes for interpreting market demand and supply. The first key aspect of the Dow theory suggests that the price discounts everything. When new information or news becomes available, the price instantly changes to reflect it. This is similar to dropping a stone into water, causing the water to quickly adjust and then return to stillness. So trading based on news might be a bad idea according to the Dow theory, because the price likely already reflects that news. Another important concept of the Dow theory emphasizes the role of volume in confirming price trends. The theory states that when price movements is accompanied by high volumes, it represents the collective view of many active participants. Conversely, price moves with low volumes may result in false signals due to limited market participation. We've talked a lot about price trends today, but what exactly are they and how do we study them? This is where Dow theory comes into practical use. So let's take a closer look at price trends. Trend is the broader direction of price movements, which represents the net displacement over a specified period of time. Trends are similar to a particular season of the year. For example, during the summer season, there may be cooler days or unexpected rains, but the overall temperature rises over the months. Similarly, the price keeps changing constantly, but it generally follows the overall trend direction. Now, according to the Dow theory, there are three broad market trends: the primary trend, the secondary trend, and the minor trend. The primary trend indicates the broader multi-year direction of the market, and the long-term investors try to align their portfolios with this trend. It can be compared to the summer season from the earlier example. This trend can be either bullish or bearish and may last from less than a year to several years. Next up, we have the secondary trend, which acts as a counter reaction to the primary trend and can result in a correction ranging from 33 to 66% of the value gained during the primary trend. This is similar to a few days of rains in an otherwise really hot summer. Secondary trend usually lasts from 10 days to up to 3 months. And lastly, there is the minor trend, which is the minor fluctuation in price and is also called noise due to its insignificance in making trading decisions. This is like a short-lived windstorm on a hot day which doesn't even lead to rains. Noise can last from a few hours to almost a month. Interestingly, all three types of trends can play out simultaneously depending on the time frame that is being analyzed, which means there can be an hour-long cold breeze on a hot and sunny morning during the winter season. Or in other words, there can be an intraday spike during a bearish week of a multi-year bull run. Remember that these trends are primarily useful for determining the trading direction, with traders selecting the type of trend based on their trading style and preferred time frame. Experienced traders often combine Dow theory with other technical analysis tools like indicators or support and resistance levels to determine entry and stop loss levels for a trade. Dow theory might be really old, but it is a useful weapon to have in your trading arsenal. You should now be able to use the Dow theory for determining the direction of your trades and combining it with your existing trading system to make it even sharper. But making your crypto trading knowledge sharper is equally important, and we're building this Polynomial Academy series to help you do exactly that. So subscribe and press that bell icon to avoid missing out on other useful videos. I'll see you in the next one.